This is the 2026 Macroeconomic Outlook presented by Michael Ogunremi, CFA. This outlook encompasses details on key macroeconomic variables, fiscal and monetary policy, and geopolitics. First, let's have a throwback for 2025. What were the key macro and financial market events in 2025, which will ultimately shape the course of the global macroeconomy in 2026? In 2025, the macroeconomic environment was ridden with tariff and trade disruption as Donald Trump resumed as the President of the United States. The trade disruption is dimensioned into two silos: U.S. versus its trading partners, and trade between other non-U.S. economies. We saw a rising wave of protectionism as countries looked to protect their domestic industries given the shocks from the U.S. Trade deals were signed, but concerns remain on implementation. 2025 was also a year of continued mounting fiscal debt, as debts in most G7 countries ballooned. Governments were looking to spend more than they earn, particularly to fund defense and other capital infrastructures. The rate at which inflation slowed down also diverged in 2025. In Canada and EU, inflation edged to the 2% target, while in the US and UK, inflation was more sticky, resulting in a slower deceleration. In Japan, inflation did not slow down. It gained momentum, fostering a rate hike from the BOJ at the tail end of 2025. With Donald Trump resuming office, U.S. policies on tariffs, taxes, and immigration changed. We saw the Big Beautiful Bill and its many fiscal stimuluses, which analysts expect to support growth. There was the establishment of the Department of Government Efficiency, DOGE, which drove downsizing of the public sector labor force. Then, there came ICE, which went all out deporting undocumented migrants. Central banks in the world largely pivoted to rate cut, except perhaps Japan, due to reinflation concerns. Unemployment and inflation readings moved parallel to each other, churning out a mixed macroeconomic print. For context, inflation decelerated at varying speeds across major economies, while the labor market cooled as tariff uncertainty and the adoption of artificial intelligence, AI technologies, buoyed hiring and firing. Geopolitical conflicts persisted. The Russia-Ukraine war lasted through the year, resulting in division among NATO members. The Israel-Gaza war escalated, and that drove the politics of having a Palestine state. Other less aggressive tensions emerged, such as US-Venezuela, China-Taiwan, India-Pakistan, among others. Most developed economies also slowed down their immigration targets, as concerns brewed over the escalating pressure on available infrastructures. In 2025, we equally saw a bull run for precious metals, which was driven by central bank gold accumulation and the diversion away from U.S. assets. Speaking of the latter, investors reduced their portfolio holdings of U.S. assets as Trump launched his trade war. We saw increased interest in euro-denominated assets. The AI boom from 2024 continued in 2025, evidenced in the lofty profits posted by the Mag 7 stocks. This drove further momentum in the S&P. One sad development is on environmental sustainability. It started with global multinationals pulling away from the net zero commitment, and then Trump withdrew the U.S. from the commitment. That's a recap for 2025. Where does that leave the global economy in 2026? Starting with growth, the outlook is that the global economy will expand faster than what we saw in 2025, but this will still be lower than the pre-pandemic growth rates. This is due to downside risks, including trade tensions, geopolitical uncertainty, rising fiscal debts, and climate-related disruptions. On inflation, the outlook is for inflation normalization, which means that inflation in most major markets should transition to the 2 to 2.5% range, which is still above pre-pandemic average. A key driving force behind this forecast is consumer resilience, particularly in the U.S., and the inflation pass-through from tariffs. Monetary policy easing will continue in 2026, but at a reduced pace as downside risks to inflation persists. Central bankers are expected to be more conflicted on rate cut, expressing diverging views on the economy as the labor market continues to cool due to sources of macroeconomic uncertainties, and inflation decelerates at a slow pace. In 2025, we saw a handful of layovers due to AI. This will likely continue in 2026 as companies look to replace their workforce with machines and robots. We expect heavy investment in AI by companies, which suggests that we may not see a burst in the ongoing AI bubble. Specialized financial instruments to raise funding for AI development and implementation could prop up in the capital market. Due to tariffs, geoeconomic fragmentation is expected to continue. The major global economies will seek to protect their domestic industries. We envisage more sector quotas and tariffs in 2026. Canada and Mexico could make compromises with China as the USMCA renegotiation takes place in 2026. Geopolitics has always been a recurring theme in my outlook, and it does not change this year. There is perhaps a higher probability of a truce in the Russia-Ukraine war in 2026, as Donald Trump pushes his ambition to end the war and earn the Nobel Peace Prize. We expect flurries of geopolitical tension in other regions, given the rising militarization and fiscal spending on defense. We do not expect countries to slow down in debt accumulation. In fact, our view is that countries will seek to borrow more, but this will come at the cost of higher yields. This could foster a disconnect between bond market yield and central bank interest rates. Countries are likely to adopt the strategy of increasing their duration exposure, that is, borrow more long-term debt. Double-digit returns on equities are expected to fade as AI momentum thins. While tech stocks are expected to still post sturdy returns, the market drivers are expected to be more broad-based. We expect to still see some diversification away from U.S. equities, but if the U.S. Fed cuts slower than expected, it could impact the forecast. Global banks broadly expect 2026 to deliver calmer markets, marked by lower volatility and more predictable central bank policy. With inflation moving back toward target across major economies, central banks are likely to hold policy rates near neutral, reducing uncertainty around monetary direction. A key market theme is the shift toward longer duration bonds, especially U.S. Treasuries and high-grade sovereign debt. Investors are expected to rotate out of short-term maturities and increasingly pursue duration plays, buying long-term bonds and selling before maturity to capture price gains as rates decline, rather than traditional buy-and-hold strategies. Global credit markets remain appealing, supported by strong corporate earnings and low default risk. Credit spreads are projected to stay tight, reflecting confidence in economic and corporate resilience, even though this means investors will accept lower excess yield relative to risk-free benchmarks. Households are expected to be better off from a nominal wage perspective, and with a slowdown in inflation, real income should improve. Consumption is expected to stabilize, but household debt and delinquency should rise as elevated prices and interest rates bite consumer purses. Due to wealth effects, the K-shaped economy is anticipated to progress in 2026. Thank you for your watching. If you are new to this channel, welcome. I post regular updates on the macroeconomy and financial market. You can follow me on LinkedIn at Macroeconomic. On the far left is a detailed list of my publications. I post an end-of-week macro roundup here on YouTube every weekend and macroeconomic snapshots every quarter. Kindly subscribe and turn on your notification. Cheers. See you in December 2026 when I present the next Outlook.